So in this section, we're going to talk about finding deals. There's a ton of different ways you can find deals, but it pretty much boils down to two things. You have on-market deals and off-market deals. So with on-market deals, you have things like the MLS, which stands for Multiple Listing Service. That's a website realtors can access to post their properties on. And then you have things like Zillow, Redfin, Realtor.com, and all those sites. So those sites just pull data from the MLS and then publicly display them. They don't have everything, but it's pretty much exactly what's on the MLS. And then you have off-market deals. So with off-market deals, it's just buying a property that's not on the MLS. There's a ton of different ways you can do this. You could network with people who own properties, ask them if you can buy their properties. You could knock on people's doors and ask them if you could buy a property. You could cold call someone. You could send letters. There's tons of different ways to go about it. We have come across off-market deals frequently also. That second property I actually showed you guys, I was knocking on people's doors and asking them if I could buy their homes. It's not the most efficient way to go about it, but it's just to show you guys you don't have to only buy properties that you see on Redfin and Zillow.
Any properties for sale, right?
Any properties for sale. It just takes more time, effort, and energy to get to the off-market ones. So when you're working with us, we get you set up on the MLS so you automatically see deals that fit your specific criteria. But we also start sending you off-market deals. Because I've been doing this so long, I just have people sending me off-market properties, whether it's wholesalers or other investors, where we're just able to see more deals than the average person. So in this section, we're going to dive into funding deals. We're going to talk about all the different loans that apply to these deals. So there's a ton of different ways you guys can actually fund deals. We've talked a little bit about them, mostly using 0 to 5% down loans, but we're going to dive into some actual specifics of what these loans are. So starting out, you have FHA loans, which let you put 3.5% down. You can buy 1 to 4 unit properties with these. And then we have conventional loans, which are pretty similar. There's a few different use cases for them, but it also lets you buy 1 to 4 unit properties with 3% down if it's your first property and it's single family, or 5% down on a multifamily property. And then you have second home loans. Second home loans let you put 10% down, and it's great for people who are trying to buy Airbnbs or just want a cheaper vacation rental. Typically, it has to be, 100 miles away or in a vacation town?
Yeah, so most areas will have a space that's a vacation home hub, like Bend would be an example in our area.
And then we have FHA 203K loans. So this is a rehab loan. It lets you buy a property where it's 1 to 4 units and borrow the money from the bank to go and repair this property. This is also super cool because it lets you buy commercial properties as well, as long as 51% or above is used for residential space. So you could buy a shop downtown with 2 apartments above it, and this could be a potential deal you use that loan for.
There's also the conventional equivalents of the FHA 203K loans, where you can also use renovations on a conventional style renovation loan.
Yeah, so there's a ton of rehab options for you guys to use, whether it's money in your pocket to go fix it up if it's a small amount, or if you're doing a larger amount, or even doing new construction or building an ADU. Like, these loans are available to allow you to do that with little amounts of money down, or 20% down and not live in them also. Another loan type is a VA loan. VA loans are great for veterans, and they're only allowed for veterans, but it lets you put 0% down on a property, and then you don't have PMI. We haven't touched a ton on PMI. That stands for private mortgage insurance. And when you're putting less than 20% down with an FHA or conventional loan, it's an extra fee you have to pay.
It's usually about 0.5% per year added to the interest rate.
And then we have HELOCs. So HELOCs we've touched on in a few examples of clients we've worked with, but that stands for home equity line of credit. It's a second loan you can get to tap into the equity on your home. So it's great because you can use this money for anything you want, or you can use it to go buy another property. It's tax-free, and it's actually a write-off if it's an investment property.
One thing I want to mention on all of these different loan products is there are pros and cons to each. So depending on your goals and your plans for your investment career, we may want to start with one product or the other. So it's important to get a personalized view of which loan product will work well for your situation.
And if you're buying properties, you'll probably end up using multiple of these over time. You might start with one and then move to another depending on the deal type you're doing.
Definitely.
All of these loans are based on your DTI, which stands for debt to income ratio. So a lender like this guy is going to go look at your gross income of what you bring in, and then they're going to allow all your existing debts plus your mortgage to go up to 35 to 50%, depending on the loan type?
Yeah, most 45 to 50, but it also will depend on your credit as far as how high that DTI can go.
So to give you guys an example, let's say you make $6,000 a month before taxes, you have a $300 car payment, and your DTI is 50% just for ease of math that's allowable for that loan product, you would be able to have a $2,700 mortgage. So your $2,700 mortgage plus your $300 payment gets you to 50% of that $6,000, just to give you an example.
So a quick note on that. So if we take that same $6,000 and let's say we have a DTI of 50% that we can hit, that $3,000 we have available, if you have high debt payments, for instance, car, student loans, credit cards, whatever it may be, it will directly affect how much of a house you can purchase. So if you have a $500 car payment, $400 of student loans, and $100 worth of credit cards, it's $1,000 total. Whereas previously you might have been able to qualify for around $3,000 for a monthly payment on a house or an investment property. Now you can only qualify for $2,000 of that same payment. It can really drastically affect the amount of house or investment property that you can purchase on your own.
And that's a good point to touch on. There's good debt and there's bad debt. So I'm a huge fan of using debt to buy assets that produce you income or make you wealth over time. I hate debt for car loans and other things like that, credit card payments and all that stuff. You shouldn't be using debt for a lot of that stuff. It's a waste of money. It doesn't build your wealth. It just puts you in the hole further. If you're not qualifying for what you think you should right now, there's a couple really cool workarounds. One of them is cosigners. So that is the biggest shortcut I've seen. If you don't qualify on your own, you can get a parent, partner, family member. Again, that's where partners come in. It can be a family member or an individual that's doing a deal with you, and you can use their lendability to go qualify for a loan.
Absolutely. And to touch back on those other loan products we talked about, the reason it's so personalized, this is another example. Certain loan products will allow non-occupant co-borrowers and some won't. So it's very important to decide which, if you're going to have a partner to help you qualify, that really helps us determine which types of loans that you're going to qualify for.
Another super cool part about multifamily properties is you can use the rental income to help you qualify. So I've seen times when someone can only qualify for like a $300,000 home, but maybe they can get a $400,000 duplex because it has rental income that then helps boost your DTI essentially and help you qualify for more.
Yeah, I think the most important thing to note there is we can only use the income from the units that you're not occupying. So if you're buying a triplex, we can use rental income from 2 units so long as you're not going to occupy more than 1 unit with the people that we're borrowing for the house.
So that's just the high level of finding and funding deals. I'm sure you guys have a ton of more questions about that. I sure did when I started out, and it's more than we can dive into just in one 10-minute video. But feel free to reach out to us and ask questions. Or again, if you want to shortcut your path to owning rentals, sign up below to just work direct with us.